Hi, everyone. This is Jason Burack of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a first-time guest. He's joining us from Vancouver. I found him through Jay Taylor's good Turning Hard Times into Good Times weekly radio show. He's a weekly guest on there. He has very good analysis of the gold and silver markets. His name is David Jensen, for our listeners who are not familiar. He currently serves as president and COO of a private mining company and provides strategic, operational, risk assessment, and precious metals consulting services through his consultancy, Jensen Strategic. Thank you for joining us, David.
My pleasure, Jason.
Now, David, I've listened to a lot of your great interviews on G. Taylor's program, and you cite a lot of work, a lot of research on the gold market and silver markets. In your opinion, how long has the precious metal market manipulation been occurring?
Well, it's probably been going on ever since we've had the central banks in operation with their fiat currency. But I think that the most widely cited example of a manipulation of the gold price was through the London Gold Pool operating in the 1960s, and that led to massive offtakes of the participants' gold, in particular the United States. But the manipulation there, where they were selling gold to peg the price, it got so bad that they lost 400 tons in a day, the last day before they had to shut it down, which was in essence about 5% of the U.S. gold holdings. So it's not something that people need to discuss conspiracy theory about. We can just look at the visible history, and it's acknowledged that this went on, and it failed rather spectacularly. Now, the recent manipulation has been a little bit more sub rosa, and we have to look at statistical trading patterns and other evidence to find evidence of the manipulation there.
Yeah, that's a great summary. I mean, the London Gold Pool is well documented. There's people, I guess, maybe Wall Street people or Keynesians, people who haven't done the research work like you and me, but they can go to Wikipedia, and Wikipedia even shows, I think there's many paragraphs on the London Gold Pool. So yeah. It's a well documented that actually happened. I believe the London Gold Pool, David, was actually overtly trying to, whether it was the London papers or the New York papers, because it was mostly the British government and the Americans who were involved in this post-Bretton Woods. They were actively running ads, I think, telling discouraging savers not to buy any gold because it would hurt the economy, yeah. And that type of saving, it was unproductive, and money needed to be invested in productive things like new products or services or technology to create jobs.
Yeah, they were trying to protect a pegged price for gold, and there was incredibly silly statements like the Secretary of the Treasury saying that they would defend the peg to their last ounce, which is. When you think about that statement, it's just amazing, and it kind of gives you an idea of the people that are involved in these things, their mental balance. But anyways, it's the London Gold Pool is well documented. The more recent manipulations, really, there's some interesting history there. But Richard Pomboy in 1997 is really the earliest reference point that I can find, and he said at a presentation at Grant's Interest Rate Observers Investment Conference in 1987 that he had identified roughly 1,500 tons a year that would have to be sold by central banks or leased in these off-balance sheet transactions. They're Enron-style transactions where they show a balance sheet with gold on it, but they don't say that the gold is due returned when they're leasing it off-balance sheet. So he identified roughly 1,500 tons a year that was having to flow into the market to meet the demand. And then in 2000, and around the turn of the millennium, James Turk, Reg Howe, and Frank Veneroso, all three of them did independent studies, and they came up with similar, 1,000 to 1,500 tons of leasing into the market per year. So, it's independent sources and people who are using real statistical analysis, and James Turk was over in the UK and studying the import-export market and identified these numbers. And as I say, Turk, Howe, and Veneroso all came to the same conclusion. So, I think that we have pretty clear evidence now that there's been an ongoing leasing program, as well as the structure of the LBMA, which I think is really the greatest destroyer of price discovery in the gold market.
Yeah, I think there's been an attempt in different creative, I'll use in quotes, ways to try to manipulate the gold price or discourage it for a very long time, probably over 100 years now. And there was a book, by Jacques Rueff, the guy who advised de Gaulle to leave the London Gold Pool and start accumulating mass amounts of physical gold. Jacques Rueff was, alive during World War I. He was a young man, and then he saw after World War I the gold exchange standard, which was a fraudulent gold standard. And he talked about in his book, The Age of Inflation, which is free, and our listeners could go get an ebook of it for free. It's out of print now. About, how the gold price was set too low, how the paper exchange, the paper reserves that these countries were carrying, they were drastically overstating how much gold they had. They were leveraging up how much gold they have, because back then, if you only had a certain amount of gold or dollar holdings, you were only supposed to have a certain amount of money supply, and how, all these different countries were cheating with it off World War I. So I think there's always been, really since the 19 teens or 20s, there's been an attempt to figure out, a way to get off of gold, because it was a constraint to the welfare warfare states for these countries, whether it was England or the United States, because they wanted, larger militaries. They wanted these welfare programs. The politicians wanted to be able to spend pretty freely and not have to worry about the consequences of their actions while, they were still in office, and let someone else hold the bag later, after they were gone.
Yeah, it's always money for nothing, for whatever the excuse is or whatever the program is. But that's the goal. And, as you say, there's always a new scheme, a new technique that's used. Personally, I see the most destructive of the manipulations as being the destruction of price discovery in London, which is about 85% of the daily gold and silver trading globally. And the introduction of these unallocated contracts in the late 1980s is roughly when they were introduced. And what that allowed investors to do, and really the bullion banks to do, was to trade contracts which weren't backed by gold or silver, and so they call it unallocated, but it's really digital or notional gold that they're trading, and they're calling it gold and silver. And it's gotten so bad, Jason, that we look at the London, their clearing statistics, and combined with their London liquidity survey, local London liquidity survey from 2011, and they state in there that the daily trading volume in London is really 10 times the number that they post in terms of the clearing statistics of the daily trading. So if a bank buys 10 ounces and sells 9, they post 1 ounce of trading versus the 19 ounces that would go between the two when you do the net clearing. And so the ratio is 10 to 1. And in reality, we see that London, using that number of 10 to 1, we see that their daily trading volume is about 200 million ounces of gold on a daily basis in London, and of the order of about 1.7 billion ounces of silver a day, which are astronomical and really, they're laughable numbers.
Yeah, and to add to your point there about price discovery, I mean, for the people, it's discouraging people in the West who have accumulated, because they, especially if they're looking for a higher paper price, they're not buying the metal just for insurance and wealth preservation. They're looking to make capital gains on the metal. They see the paper price going down, but it's hurting the miners the worst.
It is, yeah.
Yeah, you're up in Vancouver, David. You advise, I guess, mining companies up there. You're familiar with the juniors up there in Vancouver. Most of them are juniors, right? Not actual producers in Vancouver.
Yeah, I mean, Goldcorp is here with its head office and a few other intermediates, but primarily it is the juniors. Yeah.
Yeah, and the miners right now. I mean, I look at the balance sheets of these miners. Most of the gold and silver mines that were brought online after 2009. The prices that were needed for these mines to be economic, we're way below those prices in a lot of aspects. And maybe the miners have been able to trim a little bit of fat. I think some of the miners, David, in the last 18 to 24 months have cut maybe 30, 40% of their costs. Maybe they've high graded, they've canceled their exploration budget, they've slashed their SG&A. This lower oil price is a nice temporary benefit to some of these miners, but still the costs are not, 50, 60%, their mining costs are not 50 or 60% lower as you might expect with a lower oil price. They're maybe, 30 or 40% lower than what their costs were even a couple years ago. And we're still not seeing consistent profits from the miners then.
The miners are really killing themselves by using the LBMA price as their point of reference and then feeding their metal through the LBMA, through the over-the-counter market there. But there's some studies that look at. I saw one in particular from a Swiss investment house that looked at the top 8 miners in the world in terms of gold production volume, and their all-in costs, including the amortization of capital, of capex, which most mining companies don't consider in terms of their cost of production. But when you look at the true all-in costs, they're running about $1,600 an ounce. And so this paper reference price, it gives you an idea of how silly the market has gotten, and we can see why these PE ratios are dropping so heavily for the mining companies, is because their true costs are, in reality, they're really losing money on their projects, and it's killing development of new mines, and it's killing exploration for new deposits. But really have to look at the mining companies in terms of they shouldn't be selling through an exchange like the London Bullion Market Association, which is really perverting the price discovery of gold and silver.
Now, what do you think the miners should be doing instead then to get a better price on the gold and silver? Should they be selling it directly to the refiners or contract with the end users? What should they be doing instead, in your opinion, so they can actually make a profit more consistently?
Sure. I think that what they need is an exchange which truly trades gold and silver. We're looking at London there, that their notional open interest, if they're trading 200 million ounces a day, their notional open interest, if you use a 2x number there on the daily volume, is about 400 million ounces, and we know that metal doesn't exist. So, there's false metal that's being traded in that market, and there's false open positions that are unbacked, and that dilutes the available gold if people are relying on that. So the miners really need to start up a miners exchange, and it has to be one that's based on the Shanghai Gold Exchange model, where the SGE, as they call it, to write a contract there, it's a 1 kilo contract that they write, and you have to deposit a bar on the Shanghai Gold Exchange before you can write that contract. It's a real market. But what they're doing really is they're acting as an enormous physical gold liquidity drain on the West, and they are trading gold on that market, but it's influenced by the daily London price, which is where this enormous liquidity suck is being focused by the Asian markets.
Now, it's an economic law, David, that eventually, if a commodity is mispriced or an item or good is mispriced, and there's strong demand for it, and demand is increasing, but the people who produce it can't make a profit, eventually there's going to be shortages because the people who produce are either going to go bust, or they're not going to bring any more supply on. They're not going to make the investments necessary to meet demand, right? This is I guess the best summary of what we have now is it's unsustainable, but I can't give you an exact timeline on how long this unsustainable event will continue on.
Yeah, the Western investors, if you think especially of the fund managers who hold the bulk of the capital for investing, they're price followers, and they get their bonuses based on quarterly performance. And if the price is falling in London, they are driven out of these metals, and they don't look at the fundamentals, and they don't really care. Because if it's a falling price, it's a falling price. And you hear so many times, you hear that statement, the price is the price. And well, it is if you use the LBMA, and if we keep relying on that market for price discovery. So we really need a new trading platform in which we have true price discovery. And as you say, that what we have right now is a form of price control. And we know that the results of price controls are empty shelves. We saw that in the 70s in the United States. And, and also there's Gresham's law at play, which states that bad money drives out good. And if you look at these virtual or digital assets that are traded in London, they're really a form of bad money. They're a dilution of the available metal that's out there. And what you have with Gresham's law is that the good money disappears, and the bad money is the last thing that is still circulating. And I would expect the physical metal will disappear from these exchanges, and there will be extraordinary liquidity issues. And we're seeing, in the last couple of years, in terms of the London GOFO, and in particular also now the Palladium forward offered, they are both now negative. Gold is right at zero, but it has been fluctuating on and off negative, and the Palladium forwards are indeed negative. So we're seeing this physical metal pressure. And these fund managers who are poo-pooing precious metals are going to be caught short because they're going to be out of them when we have a market event from whatever the cause is. Personally, I think it'll be palladium, platinum, or silver, which will lock first in terms of physical shortage and lock up in the market because there aren't these vast above-ground stocks as there is with gold.
Yeah, and those also, palladium, platinum, I'm in agreement there about palladium, platinum, and silver. Those also are used an enormous amount in industrial. So they do have silver has a monetary component, platinum and palladium a lot less so. But they're used so much in industrial, and they're used in very tiny amounts. And a lot of the metal is not actually really recyclable, especially at the prices they're at now. There's just no incentive. But to add to your point there about most of the traders, these traders who trade commodities, they never actually take delivery of the metal. So they do a lot of fancy trades, leverage trades, fractional reserve bullion market there. And, they never actually, even if they're long a contract, they never actually want to take delivery. They just want a paper profit.
Yeah.
But what we've had for the most part, David, for the last couple of years is we've had traders like basically actively shorting the paper market to drive down the price, make money shorting it. And one of my major friends, Dave Kranzler, I don't know if you're familiar with his work over at Investment Research Dynamics. He's a gold fund manager, a good friend of mine. And, he subscribes to this very expensive gold letter. And he was telling me how the investment banks on Wall Street were, making so much money short in the paper market while they were withdrawing, hundreds of tons of physical gold from GLD and then selling it onto the Indian black market for enormous premiums.
Yeah.
So, they were making money shorting the paper market while they were withdrawing the physical gold and then, making over $100 an ounce premiums.
Yeah, no, I'm familiar with, quite familiar with Dave Kranzler. I run an Austrian Economics discussion group, and Dave is a member of it, and I'd like to invite you onto it as well, Jason. But, yeah, there's all kinds of games going on. But, ultimately, I have to hark back to the work of John Exter, and John was on a board of governors of the Federal Reserve. He passed away in, I think, 2005, but really an incredible man in terms of his writings and the warnings that he gave us of the dangers of untethering currency from gold backing, because it would lead to runaway debt markets. And that's really what we've seen now, Jason, is this rigging of gold and the short-circuiting of the gold price has led to explosion in the level of outstanding debt globally. Now, the Wall Street Journal estimates it's over $200 trillion on a global level, and it's about twice where it has historically been in terms of a stable 150% of GDP historically. So we've got $100 trillion too much leverage out there as a consequence. And John Exter warned us that this excess debt that's out there would act as a deflationary force, which would lead to collapse, and that the ultimate result was currency failure, hyperinflation, and gold basically going into orbit in terms of price, but ultimately becoming unavailable in practical terms.
Yeah, I've read articles on John Exeter's inverse expansion pyramid. I haven't read his full books. I know Trace Meyer put out an extension of his work where he cited, John Exeter's inverse expansion pyramid, talking about gold, his great credit contraction book. Yeah. I think he still sells it on his website for like $5. I skimmed through that book. I didn't read the whole book, but sorry for interrupting,
but there are three excellent articles to refer to, and they're posted at goldmoney.com. And the series is called A Banker for All Seasons. And there's a part 1, there's a part 2, and there's a part 3, and they all deal with John Exter's work. His last name is E-X-T-E-R, and we can look to those in terms of his explanation of the inverted asset pyramid with gold at the
very bottom
of the fulcrum of the inverted pyramid. So, and he said that we would experience a deflationary crash, and I have to admit that I thought that inflation would be a part of our crash all the way along, but we are indeed seeing deflationary aspects to the crash that we are in now, that I believe that we are in. But the end result is debt failure, people jumping into cash and then realizing the cash has no value because the banks will print it without limit, to quote Alan Greenspan. And that the result then is there's a flight into precious metals. And as we know, the precious metals market is 1 or 2 or 3% of the a global asset base that's out there.
Yeah, or the banks will steal it, with a bail-in, because I think we're seeing all this legislation passed as, insurance in case they can't do a bailout because the people come out with the pitchforks. But I think we see, depending upon your definition, if you're using an Austrian School definition or not, or whether you're using a Keynesian definition, we're seeing, a mix of inflation and deflation in different parts of the economy.
Yeah.
I've spoken with a ton of deflationists too. I've read a lot of their work, but the deflationists won't concede that there's enormous asset price inflation. You're in Vancouver. I'm sure you're aware of the property bubbles there. I've been up to Toronto. I've seen the housing stuff. I'm right outside of Washington, D.C. A good amount of money, 6 figures, 7 figures, doesn't buy you very much here in Washington, D.C. in terms of real estate. We've just seen, the bond market is rising due to inflation, which the deflationists won't admit, and the stock market's going up like crazy due to inflation.
Well, the bond market is rising because of intervention by central banks. If the intervention wasn't there in terms of printing money and buying the assets, the bond market would be falling. So I think what they've done is delayed the asset transition. As you go down through Extra's pyramid, you get to the bottom, which is near the bottom, which is government bonds. Second from the bottom is cash, and then the very fulcrum itself as a separate asset class is gold, and I would add silver as well. But I think what we're seeing, though, Jason, is we're seeing inflation in the things that are vital for your sustenance. And that would be food. I think the energy story is still going to shake itself out here. I don't believe it's a sustainable drop in energy prices.
I agree.
But healthcare, education, I mean, the crucial things for life are going up in price. But we're seeing excess capacity almost everywhere in the economy. And I think we're going to see dropping earnings in reality when you strip out the manipulation that's going on in the market. We're going to see dropping earnings. I think one thing that's happening right now is that with the share buybacks that they're artificially supporting PE ratios. But I think that once those buybacks stop, we're going to see the reality of where the stock market is at.
Yeah, I mean, the share buybacks, they can't, most of these large companies on American exchanges, they can't grow their top line. They can't grow their revenues. So, and the executives want enormous stock options packages. They want to get rich quick over the next couple quarters.
Right.
So they're doing financial engineering with all this cheap debt to goose their earnings higher, but they're not really growing, like you said.
Yeah, corporate debt has never been higher.
Yep, and they don't have they're not generating a lot of free cash flow on their balance sheet, a lot of these companies. They're not investing it in new products or services. They're not investing the money in research and development or new factories, a lot of them. The money is just going, because it's so cheap, it's misallocation of capital.
Yes.
The debt is so artificially cheap that, the corporate finance officers of these large companies, they run the numbers for their finances and they see, it doesn't make any sense to do anything else but borrow as much debt as possible and buy back our stock and then just make our earnings look higher than it really should be.
Right. Yeah, there's a very much an artificial picture being placed to investors when they look at just the raw numbers.
Now, why do you think mining companies, David, you're up in Vancouver, and I'm sure you go to research conferences up there. I've interviewed Keith Neumeyer at length. He publicly admits in his conference calls and stuff that the markets are manipulated, the gold and silver markets are. He's very controversial, but I think he's one of the best CEOs in the mining industry because he plans accordingly because of that. Maybe, off the record with a few beers at a bar after a resource conference or something, we can get a few mining CEOs or people in their organizations to admit that there's some market manipulation going on. But why do you think most of these mining company executives won't go on the record and publicly admit that there is manipulation that is drastically affecting their business? And, why won't they do anything about it that's meaningful?
Well, I think there's a series of things leading to that, but people are always reticent to stick their necks out, and we've seen so many of the people in the industry call those who are talking about this malstructured market and a market which has continued really decades of intervention, visible initially, but now really hidden. But people are really reticent to say there's something wrong because we live in a society where ever since the death of John Kennedy, that people that question official stories are called conspiracy theorists. and people won't deal with facts. They just like to. It's a very easy, just throw that label around and you don't have to think. The other thing I think is that when you start questioning central banks' interventions in the market, then you're really in the realm of questioning governments. And mining companies need government permits, and I think that there is an implied fear there, or an implied threat, that if they are critical of governments, their life might become difficult. And the other thing is that, having heard from a very senior executive of a mining company say that they need the banks, they need the support of the banks to finance their projects. And if you are openly criticizing the bullion banks and the banking industry, the fear is that they're not going to see the capital they need to build their projects. But ultimately, it's really short-termism, and it's really people are being the CEOs are being sheep in many ways. They're not willing to analyze. They're taking the path of least resistance to the detriment of their shareholders, and I think that the market is going to have to break before anything happens because of the lack of leadership. And I have to also say that I think that a lot of the mining executives out there aren't really schooled in the financial markets. They're into mining, and they're into the day-to-day of running a mining company, and they're not analyzing the markets on which their product is sold, which they should be, given the manipulation of this monetary asset.
Yeah, that's a great point. Some of the miners I talked to seem very scared about, upsetting their banks, because a lot of them have unfortunately used way too much debt to bring a mine online. We have to come up with a new business model. I've been saying this for a lot of the miners, where these miners can build their mines without as much debt. And if they can do that, they're not as beholden to the banks, where the banks can force them out. The banks have so much presence on the board of directors and stuff like that. But it just seems, the debt is available. So the miners, a lot of them are willing to do this to play the banker's game, but then they can't do the research and admit what's really going on in the market. I just think I personally think my research of the gold and silver miners, David, and based on the price, a lot of these mines, like I said earlier in the interview, since 2009 needed a much higher metals price, and those mines were brought on with debt. The costs haven't been cut enough. Those mines are underwater. We're going to have a lot of mines shut down in the next 12 months. The miners just don't have the debt or equity available for them to raise. They don't have the cash on the balance sheet. So either we're going to have, fire sale assets going on sale for pennies from larger acquisitions, we're going to have mines put on care and maintenance, or we're going to have bankruptcies in the near future, a lot of them.
Yeah, as we pointed out or touched on earlier, that the true cost of production, including amortization of mining projects, is $1,600 an ounce. We're at $1,200. And the miners are dependent on the banks to do bought deals or to provide liquidity to them when they're desperate, and many of them are desperate. And as a consequence, many of these CEOs who should be speaking out, they are not acting in a fiduciary manner to their shareholders when they're selling their metal, in my opinion, through the LBMA. And they're unwilling to deal with these things because of short-term desperation to stay alive, and those who are standing at the gate that they have to pass through are the many of the bullion banks and their associates who are involved in this process, along with the central banks.
Now, I want to transition. I want to switch gears here to talk about China and physical gold demand and China's gold reserves and the SDR and the Shanghai Gold Exchange. We've seen Kuz Jansen's numbers in Bullion Star, and I think he does the best research work. He doesn't have a $30 million a year research budget like the World Gold Council does, but yet I think he does the best research work probably of anyone tracking the real physical demand for gold out of China. If China is buying all the physical gold, all the annual mining supply in 2013, all of it again in 2014, they're on an even faster pace in 2015. Is this really sustainable for that much longer, where they're going to take all this physical gold off the market, more than mining supply, and yet the miners a lot of them could potentially shut down mines or go bankrupt? Yeah,
it really depends on how many occult sources of gold that there are out there. I think that the central banks should have leased themselves out by now, but there have been sources of gold as far as Libya goes, and Iraq, and other sources that have kept the market going. From what we can see in China, Koos Jansen's work is really excellent, and he makes the World Gold Council just look absolutely foolish because they keep sticking by their numbers, which, in my opinion, are completely unsupportable. But we're looking at net consumption by China of the order of between 1,500 and 2,000 tons this year, and India will be between 500 and 1,000 tons, and there's your global mine supply. We don't know what the other sources of gold are. I'm sure that many of the central banks are still leasing, but I think that as we see this new BRICS monetary system come into shape, that it's pretty evident, I think, to those who are observant, that it's going to have a gold component, which is going to send the gold price much higher. So I think the occult sources of gold, or the hidden sources of gold, are limited, and that we're, especially if we look at a geopolitical level, the conflict between the West and Russia, and also the startup of wars, in the Middle East near the oil centers, which would be related to I think to some kind of a currency crisis that's coming for unbacked currencies, and trying to put boots on the oil to control the oil source in advance of that. So we'll see where it all goes, but it does look to me like we have a very limited time frame before these things. We enter a new era of gold and gold pricing, and I think that Gresham's law does dictate that the LBMA and these other paper markets, basically, the market will just walk around them and go to true gold markets, such as the Shanghai Gold Exchange model.
Yeah, we're starting to see evidence here of larger investment banks like J.P. Morgan, et cetera, start to set up massive amounts of vaults in mainland China, in Singapore, and I think J.P. Morgan is involved pretty heavily in the Shanghai Gold Exchange as well. So I think they see the writing on the wall that the current gold markets aren't going to last for that much longer. I was wondering your opinion, though, on China updating its gold reserves. Do you think it's going to happen this year, or do you think it's not in China's best interest to update the market yet?
I don't know. I think that as far as timing, I really don't know. I don't think anybody knows, but I do think that China will do it at the point when it's in their best interest to do so, and I think that would be when the physical gold supply stops. So I think that the reason that they're not giving their reserves right now, or I think it's been 5 years since they've updated them, and even there's a lot of question if those numbers were correct the last time they gave them. But I think that China's interest in accumulating as much gold as they can dictates that they not let the market know truly how much they are bleeding out of the system, because I think that would induce many to rush into the asset themselves, realizing truly what a limited time offer this is in terms of being able to secure the physical metal in the market at anywhere near the current prices. Just to give you an idea, Jason, we look at daily oil trading, and the actual production of oil is roughly 20 times the daily production of gold. And so if we look to using gold as a currency, we would have to bump the value of gold enormously to settle any of the oil trade in gold, which is the petrogold trade that existed in the 60s and prior. So, it sounds really, they're astronomical numbers, but you're looking at least 10 times higher than the current price in order for gold to play a monetary asset role. And I think that will come about when China reveals its true holdings of gold. And I think it will at the same time roll out some new BRICS trading unit or a gold and yuan trading unit to settle a large part of the global trade on an asset-based currency.
Yeah, I think China they do want the world reserve currency probably long-term, but I think they realize they're not fully ready yet. So I think we've seen a good amount of videos coming out there on the internet that China immediately, in the next 6 months or by the end of the year, they want the RMB added to the SDR basket, the special drawing rights basket, as like a major first step. So they can, start to open up their currency more and get larger amounts of trade settled in RMB, and people can have reserves in RMB and stuff like that. But if I was China, I wouldn't want to tell the truth about how much physical gold I had, because they're well aware of how much manipulation there is. I think they've had multiple conference calls with Bill Murphy and the other people at GATA, so they're well aware of what's going on in the gold market. And their culture just loves gold. They're up there with the Indians and Asians. And Middle Eastern people in the Middle East. They just have an affinity for gold. They have a love relationship with it. That if there's a wedding or a birthday or an anniversary or someone graduates school, then they buy gold for them as a present, or Chinese New Year.
Yeah, it is definitely part of their culture, and they are on state television advocating their citizens to buy gold and silver. And I think that they can see there's going to be a disruptive move in the currency markets that's coming. As far as the RMB going into the SDR, the SDR really is a basket of confetti. And, to have a gold-backed currency in the SDR would really be very odd, because it would be the only thing that would really have anything of appreciable value in there. So they might do it for the short term to try to maintain things for a short period of time. But, when the Chinese do go to their gold-backed currency, which I think that they're going to have to do because they've got their own issues in terms of importing energy and financial stability in their markets. But when they do, I really can't see the ultimate trading unit being an SDR.
Yeah, I think China's temporarily going along with the SDR for a couple years or something like that until they have the other systems ready. A lot of people that were predicting that there was going to be a hyperinflation and immediate collapse before 2008, they didn't understand that the infrastructure wasn't already in place for another global financial system. There wasn't another SWIFT in place. There wasn't a lot of currency swaps in place. There wasn't a lot of bilateral trade agreements of enough larger size in place. And, now we're starting to see these announcements pretty much almost once a week, definitely a couple times a month, where China's doing deals with Russia, Russia's doing deals with Brazil. These other countries are announcing trade settlement outside of the U.S. dollar, where they don't have to do as much trade inside dollars.
Yeah, the writing is on the wall, definitely. It's a little bit disturbing because it doesn't look like it's going to be an orderly process. And we do see the ignition of these wars globally, and it's a troubling time that we're heading into. I'd like to see a peaceful transition. That's when you get real change, is when you have people thinking and discussing and restructuring things. And my concern is that it becomes disorderly, that we start seeing conflict. And I think it's essential to not have violence as part of the transition process. Because it does distort the discussion, and it results in the imposition of force by the state to continue things much longer than they can otherwise. So fingers crossed for a peaceful transition, but I see these transitions coming to us quite soon because of the outside signals of the global conflict, which is being generated, I feel, by the West to the greatest extent.
Yeah, the U.S. has the world's largest military by a very, very wide margin. But, we're starting to see a lot of signs that the U.S. empire, this humongous welfare warfare state, is very far down the roads of decline, collapse of a complex civilization, similar to the lines of the Roman Empire falling and similar to the British Empire falling. I see a lot of similarities there between both. But, the U.S.'s control of the world's economic and political systems to a large extent is very vast. But, as they create more inflation and flood the world with all these dollars, the rest of the world's getting a not very pleasant inflation burst that they've had to deal with for a very long time. I definitely don't think the system is sustainable. I'm not really sure what the next, global financial system is. But if China's going to keep accumulating gold, I don't think they should announce. Maybe they'll come out and update and say, oh, by the way, we have 3,000 tons of gold, but in the next couple of years. But I don't think that's going to be the real number of physical gold that the People's Bank of China has.
No, I mean, collapse on the part of America is not necessary. They could write down their debt. I mean, globally, the world is over indebted. It's not just America. And, globally, the world's markets are over indebted by about 50%. So there could be an orderly write-down of debt, introduction of a sound currency, and a restructuring of affairs. America has very large gold deposits in its west and in Alaska. Many of them require much larger, higher gold prices to go into production. But, for instance, the Pebble deposit in Alaska has 60 million ounces in it. There's no shortage of gold out there. And certainly America has the assets that it could go about underpinning its currency and going to a sound currency basis. But it doesn't seem that the will is there with the current administration. It's the game is to prolong paper as long as possible, and what's happening then is that the gold is being evacuated out of the West into Asian hands, which is going to lead to enormous hardship for the citizens of the West in the years ahead.
Yeah, I completely agree. There's just, especially in the West, in the United States and in England and in a lot of Western Europe, whether it's from investment bank research reports or Keynesian academics or Wall Street or the politicians, there's just a humongous anti-gold bias. The only thing that can change for them is if the gold chart temporarily looks good, and they'll write it up because they're trend traders and they think maybe they can make a little bit of money, but they still hate gold.
Yeah.
I've heard a lot of these guys go on, oh well, if the gold chart looks good, I'll buy some, but I hate gold, so then I'll sell it.
Yeah.
So that seems to be the thought process behind most of the people in the West.
Yeah, gold is hated for two reasons. I think one is the money for nothing gig is not possible. And secondly, that gold currency results in much lower market volatility. And the entire financial industry loves volatility. Whether up or down, it doesn't matter. As long as you got the volatility, you can make money in the markets. And so, both government and the financial industry are dead set against gold. But what's happening is that the other 95% of the citizenry are going to be horrifically punished, governments for that matter as well, when reality comes home to roost. The money for nothing gig will be up, and we will have a very, very difficult time if it is a disorderly restructuring.
Yeah, I mean, my crystal ball is kind of broken. I don't see exactly how the future is going to play out, but I'm happy accumulating physical silver or physical gold or a little bit of platinum and palladium, or buying, gold and silver royalty and streaming companies that can generate free cash flow at these levels, or buying miners that don't have a lot of debt and low production costs and have some cash on their balance sheets. I think, the diversification of those things, buying small amounts of those things and maybe keeping a little bit of cash on the sidelines in case we have, a manipulated event where maybe gold does go quite a bit lower, silver does go quite a bit lower, like a freak spike bottom or some spike low or something like that. I think it's very prudent. But, in spite of the prices going down and sentiment being so negative in the West, long term, I think the fundamentals continue to improve, and I'm even more bullish long term, although, in the short term, who knows what's going to happen.
Yeah, tough to say. I just think there's the potential there for a great deal of instability, and majority of savings are in the bond market. And looking at Extra's pyramid, this market is headed for collapse. And as a consequence, you're dealing with financial market lockup, and it's very difficult to deal with how to invest and what to do in that type of scenario. But that's the direction that we're headed in. I think it's inexorable. And I think because of Extra's pyramid and his writings on it, we can see where this is headed, and it's not heading in a good direction.
Yeah, it's headed, David, for a global currency crisis, a crack-up boom of sorts. Even though the dollar is strengthening, other currencies are falling very rapidly, and gold is actually going up quite a bit in other currencies other than the dollar. And, when the really, really rich people, they're buying they're not holding a lot of cash. They're buying up enormous amounts of diamonds. We've seen an enormous spike in the price of diamonds in the last 6 to 7 years. We've seen enormous spikes in artwork. I think I had Mark Faber on here about 4 or 5 months ago. He said he expects to see a painting sell at auction for $1 billion in the next couple of years. Just an astounding number. We're seeing record sales for antiques at auction houses and artwork and rare collectibles and things like that. So the really, really rich are putting their money into hard assets. They're just not necessarily, maybe they are putting a lot of money in physical gold and silver. The paper price, though, isn't reflecting this reality yet, though.
Yeah, it will at some point. The price will. It won't be the paper price. But the amount of time that we can continue with this cycle of virtual metal trading while the physical is drawn out of the system is limited, and the question is how long it can continue. I think the gold forward rate and the palladium forward rate are showing us that there is significant tightness in these physical markets, and I think we don't have very much longer with this system to go. The paper trading can go on forever, but the physical availability can't because of Gresham's law, and as a consequence, I think that we have limited days. It's always Tough to say when, but it looks like we have a limited time that this market can continue in this fashion.
Yeah, I completely agree. I don't think it has that much longer. I mean, I would just watch the miners. I would watch how many primary gold and silver mines, or even the byproduct guys who are selling gold and silver as byproducts. You know, the copper price has fallen a lot. So when their copper hedges come off in the near future, those mines are going to get shut down, and then all that gold and silver that's a byproduct is going to get shut down too. So, you know, once we see that wave where it's not just Allied Nevada going bankrupt, where we start to see a couple mines shut down a month, pretty large mines, you know, that's going to be the bottom here, because we're going to see a supply shock, some type of squeeze, where people on the exchanges then, you know, they're going to be offered cash settlement, or they're going to be told, you know, they have to wait 6 months or a year or 2 years to get large quantities of physical metal delivered to them or something like that. I think that'll be the full bottom then. You know, it's going to be very painful, though, because you're up in Vancouver. You're going to see, unfortunately, a lot of people potentially lose their jobs.
Yeah, no, it's a difficult period that we're heading into. There's no question.
Okay, David. Well, I really enjoyed this discussion. I think it was great. Please tell our listeners where they can find more of your work through your consulting firm and your writing.
Yeah, Jay Taylor's website. You can go to miningstocks.com or jtaylormedia.com. That my work is posted there. It's also posted at safehaven.com. SAFEHAVEN, and that goes right back to 2005 when I first started posting articles. Those are probably the two best sources. Also posted at 24 Hour Gold over in Europe and some of these other websites, but those are the two primary sources.
Okay, great. Well, I really enjoyed this discussion, and I'd hope to have you back on in the near future again so we can talk about the gold and silver markets. I found this discussion very interesting.
I did too, Jason. Thank you for your time.